So this is work that I have been doing for about a year with Zoltan Jakab, my former colleague at the International Monetary Fund. And it's a paper about the nature of banking. I'm a theoretical modeler, theoretical stroke quantitative modeler. I am trying to put banks into the workhorse models of macroeconomics, because that's obviously very, very important for everything that central banks do these days. And believe it or not, banks were, by and large, with some very, very few exceptions, not part of mainstream neoclassical DSGE models in academia and therefore at central banks until the time of the crisis, which is deeply troubling. And since then, people have been working on fixing that. But what we're claiming in today's paper is that what they've been doing is essentially wrong, and with some exceptions, like my distinguished colleague here, but by and large wrong. So here's the usual disclaimer that applies to both the Bank of England and the International Monetary Fund. I'm just presenting research here. Nothing that I say can be interpreted as in any way reflecting the policy position of the Bank of England. All right. So the problem that that we're pointing out in this paper is that recent models of banking, which are being used heavily to think about how do we regulate banks. So this is not a trivial academic exercise, right? They use what I call the intermediation of loanable funds theory of banking, and I made that term up, but it's composed of words that you will find all over that literature, namely banks as intermediaries and banks intermediating loanable funds. And I will claim that this theory simply misrepresents the way credit and money are created in the real world. The alternative theory that I will explain to you today, because it's not just a theory, it's actually a way of thinking about the world that is very, very useful once you start to think about regulating banks and how banks actually affect what's going on around us. I will call that the financing through money creation theory, which I will argue is in a very important way consistent with the actual credit creation process. And in March 2014, the Bank of England in the quarterly bulletin put out two papers, Money Creation in the Modern Economy, I think is the title of one, another one, it's a companion paper, by these three co-authors. And that explains in very simple terms, without any equations, without any quantitative econometric work, it explains how money creation works in the modern economy. And when I presented this paper several months ago at a conference in Oxford, John Vickers talked to me and said when he teaches money and banking, he uses the textbook, but when it comes to actually explaining the money creation process, he asks his students to put away the textbook and use these, and he uses these papers from the Bank of England instead. They're really quite useful. You don't need to be a trained graduate level macroeconomist to understand that. But what I will do today is to then simply take the content of these papers and turn them into a theory that you can actually use in a quantitative sense and show you how different that theory makes you think about the behavior of banks. By the way, I have been in correspondence with the leading mainstream monetary economists about these Bank of England papers, and he was bitterly criticizing them and saying it suffered from many, many misconceptions. This was a leading, I'm not going to mention names, but this is a leading mainstream monetary economist. And I had to reply to them and say, I'm sorry to break this to you, but there is not a single misconception in this paper. The misconceptions are all yours, okay? And so this is the battle that we're having today to get something that actually was very well understood in the 30s, 40s, and 50s back into people's consciousness about how banks operate. Okay, this slide here is a preview of what I do, and this is sort of a little academic. There are academics in the room, I believe, and I think it's important to put into context what we actually do with our modeling. I grew up as an economist at the graduate level under Guillermo Calvo, who's a famous international finance economist. And we always worked with models that actually had money in them, right? Which today's models, basically they don't have, except for the very latest generation, they have neither banks nor money in them, which is absolutely stunning. They only have interest rate. The central bank just sets an interest rate. Anyway, I grew up with a class of models where you would have something called the representative consumer, or representative household, who would hold money because it entered his utility, or because it lowers its transactions cost, or because there was something called a cash in advance constraint, that you could only do your economic transactions if you had cash. That was one feature of those models, and the second was that the money that was then put into those models was actually exogenous government money, which means it is, in practical terms, it's cash in your wallets and the reserves that private banks hold at the central bank, and nothing more. And in today's economy, that money accounts for 3% of the broad money supply here in the UK. The other 97% were completely outside the model. And what I'm arguing is that the main shortcoming of these older models was not that they were using a simple representative agent framework. A lot of people in monetary economics are trying to argue that today. Oh, we need to get more sophisticated. The micro foundations of money. Well, anyway, let me not go there. The main shortcoming is not that. The main shortcoming is that you put that 3% of money into the utility function or the transactions cost, not the 97%. And it actually turns out that modeling households as representative households is very crucial to then understand how banks really operate and how that money, the 97%, is created. So now I will get to explaining what the misconceptions are out there in our understanding of banks, and then I will present a model and show you some quantitative simulations, because sometimes, often, a picture tells more than 1,000 words, and those simulations will really, I believe, convince you at the end of the day. But it takes some time to get there. Okay? So I will talk about two key insights. One of them is that, as the title of the paper says, banks are not intermediaries of loanable funds, and I'll explain what that means. And secondly, the deposit multiplier that you will have seen, I don't know which undergraduate textbook is being used here, except for Goodhart's book. I think very, very few would exclude the deposit multiplier. But the deposit multiplier is, in fact, complete garbage. Excuse the language. There's no such thing. Okay, but I'll get to that second. The first is more important, actually. Banks are not intermediaries of loanable funds. It's a bit of a dense slide here, because what I was trying to do is to compress everything about the intermediation model and the financing model onto one slide, so that you can go to jump visually from the top to the bottom to see how they compare. Right? So the loanable funds model is basically that banks are intermediaries, but what that intermediation is essentially physical trading of real resources. Those are completely non-monetary models of our economy out there. They have people trucking and bartering goods against each other. That is essentially the model that's being used. Okay? And what happens in that model is that the bank would collect a deposit from non-banks and then lend it out to some other non-banks. And it's basically intermediating this deposit. I am the bank, I collect something from A, and then I lend it to B, because I'm good at monitoring B or whatever. Right? In this model, in some sense, deposits are an input, right? Deposits in, loans out. I mention this because the opposite is true in the correct model, in some sense. Money in this model is exclusively held as a store of value. There's no medium of exchange function of money. You could put it in, but it's non-essential, and the model works exactly the same way if it's not there. Right? And that's important, because the goal of money as a medium of exchange is non-negotiable as far as I'm concerned. That needs to be in a realistic model. And finally, if you want to exchange, if you want to explain why bank balance sheets can be so volatile as they are in the data, as we will see in the end, you need to put forward this idea that, oh, the households can either put their savings in the bank or they can directly hold stocks and bonds. And that's why bank balance sheets sometimes shrink and sometimes increase. Right? I will show you in the data that story has almost zero explanatory value. The explanatory value comes from the other story, which is financing. Financing means that when banks make a loan, they digitally create new purchasing power. Right? Or 50 years ago, they used a fountain pen to create new purchasing power by entering something in their ledgers. Right? So I was a banker at Barclays Bank for 5 years, working somewhere not far from here, and I made loans. So somebody came into the bank and wanted a loan. I would look at his business case or her business case and would say, and would eventually decide, well, this guy or lady is good for the money, and I will extend the loan. So what do? I create a loan entry on the asset side of the bank balance sheet, which says, this person owes me the certain installments over the, let's say, the next 5 years. That's my asset, because this guy owes me. At the very same time, let's say it's £1 million. At the very same time, I create an entry on the liability side, also £1 million, in the name of the same person who came into the bank, because that's what he came to the bank for. This guy didn't come to the bank and said to me, I want to be in debt. No, this guy came to the bank because he wanted to have money that he could use to purchase something with. And the way to create that money is to get a loan from me. Right? And so the guy gets the loan, notice that the story that I've told you has nothing to do with intermediation. I am the banker, one person comes into the bank, there is nobody else involved. This is no intermediation, this is creating purchasing power. And my light is going on. I better keep talking fast so that it doesn't happen again. I think it's here. Here.
Yeah.
And then
you
click
have
on
to
this.
press just one button.
There we go. Okay, I'm always going to move it around then so that this doesn't happen again. Although, yeah, that's it. No, yeah.
Just keep your finger down. Keep it down. Click.
I think it's best if you I think you know the magic you have to do.
Yeah, you have your finger.
Long-term solutions to display settings are important because it thinks there's another screen there.
Yeah.
And it's in French, so I can't tell you what display settings are in French. See if you So you permanently fix the mistake by going to system settings, which is the
on paper.
You keep that bit.
Maybe click on that arrow.
Yeah, it's just a bit small.
So it's opening over there to the left of the screen because it thinks that the screen is one.
So you go to system
Just try
settings.
left or you try left or right with the 3 fingers.
Do you want to try?
Yeah, can you do it?
So if you what are you supposed to do?
Can you move? And does it work? This? Oh, this works. Right.
Yeah.
Okay, so deposits in this model are in some sense an output. The guy comes to the bank, gets a loan in order to get the deposit. The deposit is what he came for or she came for. Right? Money in this model is held as a medium of exchange. Any model where money is held as a medium of exchange, of course, money is also a store of value. This is always there at the same time. Right? Now, if in this model we want to explain rapid changes in bank credit, such as we observe in the real world, then, I'm just moving it so that it doesn't go away. Then you can explain that by changes in gross balance sheet position. Because what the process that I just explained to you, the bank can increase its balance sheet by £1 million at the click of a button by extending additional credit against the collateral of some asset or something like that. And if there is a crash, it can call in lots of loans or not roll over lots of loans, and the process goes into reverse. This has nothing to do with savings. This also has nothing to do with some saver deciding that he or she is going to invest in stocks or bonds instead. This has something to do with banks writing up or writing down the gross positions on their balance sheet. And these gross positions are not negligible. And traditional or mainstream economics has a big tendency to only want to argue in terms of net positions and in terms of real resources. That's not finance. Finance is all about these gross positions, how they are created and how they are destroyed. So you will often see charts of this nature where, for the conventional model, there's a saver, deposits goods, and the arrows go, and then the bank loans the goods to somebody else. And the arrows go from right to left. This is all over the literature, including advanced economic texts. The arrows go the wrong way. The arrows actually go the other way, logically. Temporally, it's all at the same time. But logically, it starts with the loan creates the deposit, and there is no saver involved in this. Later on, there might be a saver because when the investor or the borrower spends the money and the money ends up with somebody else, he might end up saving it. But that's a secondary story. The creation of the additional loan and additional deposit is something that is entirely independent of a desire to save. Okay? It's creation of purchasing power. Now, I'm never sure whether I'm actually on the next page. Yeah. These models behave very differently, but in the interest of time, I'm gonna no. Let me talk about this. So, in the Loanable Funds model, we will see that this model behaves very gradually, sluggishly. When there are financial shocks, the size of bank balance sheets is going to change very slowly. And this is because deposits in that model come from a physical process of saving real resources, meaning I have to work harder or consume less in order to have something left over that I can deposit in the bank. This has nothing to do with how bank balance sheets really grow. Okay? In the financing model, deposits are created on a computer as book entries, and that's a process that is instantaneous. It can be like that. And the actual real resource cost of creating these deposits is virtually nil. It doesn't mean the bank is going to do it willy-nilly. It's not going to just do it. But it's going to solve a profit maximization problem to do this. Right? It's going to say, am I going to get my money back when I make this loan? So the constraint is therefore on bank lending is not, are there enough savings? It's also not, are there enough central bank reserves? It is just simply, is it profitable or not? And the important thing is that banks' view as to whether something like that is profitable or not can very quickly change over the business cycle, which can explain a lot of the volatility that we observe in the data. Okay, deposit multiplier. This is something that, as I mentioned, you have very probably seen in undergraduate textbooks. So the central bank creates some additional high-powered money, and that then gets lent by the first bank, ends up as a deposit in another bank, and gets lent and lent and relent, and eventually you have this 10 times the original injection is then the total money base, brought money or something like that. Now, we know since Kittlin and Prescott that that's not even in the data when the central bank does try to control reserves. Right? There's an academic paper that shows that. But under today's regime, we are not controlling reserves, we are controlling the interest rate. And when you have a market, right, a diagram where the quantity is on one axis and the price is on the other, once you control one, you have to let the other adjust. Right? So if you control the price, you have to let the quantity adjust, meaning reserves in today's economy, by and large, except when you're in crises and stuff like that, by and large are endogenous during normal economic times. Okay? So that it makes no sense to talk about a deposit multiplier. You can compute a number that you can call it the deposit multiplier, which is the ratio of broad to very narrow money, but it's meaningless. It's meaningless in the sense it doesn't signify any kind of economic transmission mechanism. Okay? So, conclusion is, when you look at banks, the transmission always starts with banks deciding to create a loan. This loan creates a deposit, and the reserves are an afterthought. They will be endogenously supplied if the banks think they need more. This is a quote by somebody who was at the time vice president of the New York Federal Reserve, says it as succinctly as you can. In the real world, banks extend credit, creating deposits in the process, and look for the reserves later. That's exactly what I have in the paper here today, in the formal modeling. That's also exactly the idea in the Bank of England quarterly bulletin articles from March 2014. Right? Okay, so then this is just a verbal description of what's in the model. And again, I focus on the financial sector because the rest is relatively standard. So, banks provide credit not by lending out loanable funds, but by writing up their balance sheet. In fact, and this is typically the slide where I try to provoke the academics, where I say there are no loanable funds. There literally are no loanable funds. When I as the banker sit opposite my potential borrower, I don't look over my shoulder to see whether I have enough loanable funds. I think in my mind, am I going to create new funds in order to lend to this guy? That's what's going on. Okay? And when it comes to the bank liabilities, household bank demand deposits, these deposits are not real savings. Rather, they are basically the medium of exchange in the economy. And in fact, there's another very frequent misconception in the literature on banking, which is that banks collect deposits from non-banks. No, they don't. They create deposits for non-banks. Right? This literature is rife with microeconomic thinking to think about macroeconomic issues. What happens when somebody comes into the bank and deposits a check? Does this bank have more money to lend? No. Because the moment it receives the check, it acquires a claim, which is an accounts receivable asset, which is its claim on the bank that the check is drawn on to collect the fund that check represents. And all that this is going to do at the end of the day, it's going to move existing deposits around the banking system. You know, I had a discussion with a leading super duper banking economist the other day. And he was telling me that, well, when I go into the bank and I deposit a check, etc., and I said, you know, your university writes that check, and when your account gets credited, then the account of your university gets debited. There are no additional deposits, right? The only way in which deposits can grow, or there are a number of ways. The main way is that banks make a new loan and thereby create a new deposit, or banks buy assets, because banks can buy assets and pay for them by creating new deposits. When a bank buys a building, it basically creates a deposit to pay for it. When a bank pays its employees, it does that too, right? That's how these assets get created. Bank equity in our model will be subject to Basel regulation, and the other points are a little academic, so I'm going to jump over that, like graduate academic. So I'm going to now present to you some impulse responses. Impulse response is basically where you have an economic model that is in a steady state, and then you shock that with something, and you see how the economy adjusts to that shock, right? And the models that are underlying these simulations that I'm going to compare are completely identical, except in one respect, which is the budget constraints of the agents. And for some reason, when we did this whole, yeah, no, there it is. And this is where the difference is. So the difference is in model 1, which is a loanable funds model, you typically have a saver household and a borrower household. I mean, I've written it down in such simple terms that I'm sure you've also seen that in undergraduate work. So this is just at the conceptual level, right? So typically you would have a saver household who deposits something and a borrower household who borrows something. Ignore the fact that I have capital here and that other budget constraint of the borrower. That's not even necessary. You could have a consumer loan and you wouldn't even need to have that. Okay? So what happens is that the change in deposits of the saver are equal to his income minus his spending or her spending. Income is real, how much I work and thereby generate in terms of income. Consumption is real, right? There's nothing monetary about this. Plus, in any economic model, income and consumption tend to be processes that are not very jumpy because they're flows and people are averse to volatility in those flows if they have normal preferences, right? If they like to smooth their consumption, they like to smooth their income, which means that these flows can change and will change over time, but not in such a way that the stocks, which are the deposits here, the savings essentially, jump around like crazy, right? And therefore, in this model, you can see, and I call this predetermined variables. This is a technical term, but we'll see very, very clearly in the impulse responses in the simulations how that is reflected there. And for some reason here, on the Mac, something doesn't display well. This probably never happens on a non-Mac. So never mind. You can see that those circles are around loans, and they should be around deposits up there. Now, in the financing model, essentially what I do is I collapse those two budget constraints into one. I have one representative household interacting with the bank. So then, alarm signals, right? So why do we need a bank if it doesn't intermediate between savers and borrowers? Because the function of the bank in this model is to create purchasing power. And it creates purchasing power through loans. It creates money through loans. The majority of our money is created through loans. And so therefore, but that's costly, right? If I get a loan, I pay 5% interest, and the deposit is going to get me 2% interest, it's costly for me to do this. I'm nevertheless willing to do it because money in this economy fulfills an essential function. It saves transactions costs. And so as a borrower, I am willing to do this. Now, if my budget constraint looks like this, and forget about the capital, I have my change in deposit, my change in loans, and on the right side I have income minus spending. If I want to increase my deposits in this model, my income and my spending don't need to change at all. My income and my spending, remember, are these real things. I work more, I consume less, blah, blah, blah. Doesn't need to change at all. I can change this and this by the same amount, and I will have my deposits, which is what I wanted, right? If I want more deposits, I just get more loans from the bank to have it create more deposits for me. Now, you can see that because this does not require physical effort, you can see that it can happen very, very quickly, as long as the borrower and the lender think that this is a mutually advantageous thing to do. Okay, and so now let's look at that impulse response. And does everything display okay? Yeah, on this one it does. So what we have here is a shock to the riskiness of corporate borrowers of banks. Right? The banks suddenly wake up in the morning and say, whoa, the borrowers are a lot more risky than we thought, and therefore we have lent too much money at too low an interest rate. Let's change that. Okay? Now, on the right side I have the various financial variables, and on the left side I have the real variables. And the dashed line in each case is this typical loanable funds model, and the solid line is the model that I propose. And on this axis we have 16 quarters, so we're looking at 4 years. Right? So when the loanable funds bank, the main textbook sort of bank, wakes up and says, oh, we've lent too much, then it says, well, I cannot really change the quantity of my loans very much. right? Because the quantity of my loans is determined by how much Granny brings into the bank in terms of savings, right? Granny has to come into the bank and withdraw some savings, and then my loans will drop, right? And so you can see that here, the bank deposits hardly change at all in that dashed line, and as a consequence, the bank loans also don't change very much. And as a consequence, all the action is in the price, right? The bank charge, because the borrowers are objectively riskier now, so this bank charges a higher loan rate. In the financing model, the same bank wakes up in the morning and sees this and says, we're going to do two things. We're going to lend less and charge a higher interest rate, because lending less has nothing to do with savings. We're just going to call in some loans, and that is going to cancel some deposits, and that process can be very, very quick. And so you get a 5% contraction in a single morning, if you want, in the balance sheet of the bank here. And as a result, the remaining loans, because people are not so heavily in debt now, are actually not so risky anymore, and that means it can increase its spread by less, right? Its interest rate spread by less. You can see that up there. So that's the action. So you get much more action on the quantity side, which is what we'll see in the data. Let me jump over this because it's again an academic point. And then on the real side, we see that the financing model also predicts a much bigger contraction in output. And this is because when this model basically says that when suddenly a lot of liquidity is withdrawn from the economy, this makes it much more difficult to conduct transactions, so less real economic activity happens. And that means GDP contracts by far more. So I think I'm probably not doing very well with time. I would like to show some data. Do I have time for that? Yeah. We're right now doing some really hardcore quantitative work, econometric estimation of models like this, but that takes time. So in this paper, all I have for you is some stylized facts. So what the new model predicts is that credit and money can exhibit very large and discontinuous jumps. Do we see that in the data? Second, forget about that. Pro-cyclical bank leverage, that's the bit academic. And third, credit crashes have a large quantity rationing component. And there's a large literature out there that actually shows that. So take that from me. And so we are only going to look at one here in the limited time that we have. Yeah, this jumped over one of them. Anyway, let's just do this one. So these are scatter plots of different national banking systems, which have the log of bank assets on the horizontal axis and the log of bank debt, the change in the log of bank assets, and the change in the log of bank debt and the change in the log of bank equity on the vertical axis. And this is time series evidence, so there's lots of data points for each economy, and it's this averaging over the entire banking system of those economies, essentially. And so basically what we see is that these red dots are the relationship scatter plots. This is a relationship between debt and assets, bank debt and bank assets. They basically move almost one for one. This is a very prominent feature of the data that many people are now recognizing, right? And a loanable funds model actually struggles mightily to generate this feature, whereas in our model this is exactly what you would expect, because a new loan creates a new deposit, bank loans create bank debt, it's like that, right? Is this the next slide? Yeah. Here we have time series data since this is all messed up because it's the Mac. Starting, I think, in the 80s and going until until recent, 1 or 2 years ago. And the blue line in each case is the change in banking system balance sheet, in the size of bank debt relative to the GDP of the same quarter. The red line, and in the US case, the green line up there, is net private saving ratio. Forget about the red line up there for the US. So what this illustrates is the enormous fluctuation in the size of bank balance sheet over the business cycle. very, very large relative to GDP, up and down by big percentages. And this isn't just because valuations change, and this is also not just because there are interbank positions captured here. This is just the same picture, and I think this, as far as I remember, this picture is for just straight credit to non-banks. And straight credit without the valuation effects that come when you hold securities that are valued by the market. Right? You see, this is extremely volatile. Look there in the United States, the blue line also has a trend that's way above the trend for saving. And that is because the size of the aggregate balance sheet of the financial system grew relative to GDP over that entire period. The overall balance sheet relative to GDP doubled over that period. Right? And if you look at the savings ratios, net private saving to GDP, which play a central role in the loanable funds model, they're very, very smooth. Right? They have nothing to do with each other. Because bank balance sheets and what happens to them has nothing to do with this. Right? Or almost nothing. This is the most interesting slide. So here you see the contraction in, that's what I want to focus on here. This is again, this starting in 19 going until I think 13. The contraction, in this time in millions of US dollars, of the US banking system around the time of the Great Depression. Right? And you see it's just absolutely humongous. Right? Especially the total, which is this line, all kinds of credit. Right? If you look just at the red line, that's the corporate credit. And then the black one is household credit. A huge contraction. So how do we explain this? Well, people from the savings school of banking went out and said, okay, so these households must have reallocated their savings away from the banks and towards capital markets, i.e. to bonds or stocks. Right? Now, these are changes in stocks. The magnitudes are exactly comparable during that period. A little upward blip. It's almost nothing compared to the change in credit. Right? And by the way, remember, it is only large corporates who can actually do this. And the majority of credit in modern economies is not to large corporates. That's about 10 to 15% of overall bank credit. There's a much larger share that goes into housing mortgages these days. And if I have a mortgage and the bank doesn't want to extend it, I can't go to the bond market. Right? And so that explanation doesn't fly at all once you go away from corporate credit. Now let's look at this corporate credit, just corporate credit itself. That's that same red line, that contraction in credit that we see. And now we plot it not against just the change in bonds, which is now this green line, but also the change in equity. Did they issue more equity? Yes, they issued more equity. Those are the blue bars. So that was a partial offset. But who bought that equity? It's not households. These blue bars and the green line show what households actually did. And this includes indirect holdings by households on mutual funds, hedge funds, pension funds, insurance companies, etc. It's all included here. And you see that households almost didn't change their holdings of corporate debt and equity at all during the crash of the Great Recession. In fact, it was domestic and foreign financial institutions. So these things moved around among financial institutions, but not to the household sector. So there was not a switch in savings at all. So, conclusions. The main contribution of this paper it's a graduate level paper. I'm trying to sort of tell it at a level that's understandable for everybody. But the main conclusion is basically, we're thinking about banks the wrong way. You don't, but a lot of people think about banks the wrong way. And this leads to potentially serious implications for how we think about, what do we want to do about them, and just how do we think about them in the context of policy, right? And so I advance one model here that is able to fix that, right? And so we see that when we do a model comparison, a quantitative simulation, this alternative model predicts far larger changes in bank lending, far faster changes in bank lending, which is even more important, much smaller changes in spreads, and much larger effects on the real economy. So clearly, for any quantitative evaluation, this is very, very important. And also, it's more consistent with a number of stylized facts, but stylized facts are always, hardcore econometricians will tell you that's not enough, and it isn't. That's why we're doing the hardcore econometrics now. Last slide. No, it doesn't want that. That was the last slide. Was essentially, there are all these models in academia where we're now thinking about how do we regulate banks? How do we do macroprudential regulation, countercyclical capital buffers, and all that stuff you will have read about in the papers if you follow that. And almost that entire literature is based on the loanable funds theory of banking. And what I'm proposing here is a research agenda and a thinking agenda, is basically to use this alternative model class, think about it again, evaluate these things again. And we have started to do that at the Bank of England. And exciting times ahead, because there's lots to do. That's it. Thank you.
It's great to have heard Michael again talk about his work and the bank's work. It's interesting that the way the bank has always thought about monetary aggregates, what used to be called monetary assessment and strategy division still is, but used to be called Div 1 in the very old days when I started my career. We always had these kinds of views, and it's taken DSG modelers such as myself and Michael another 20 odd years to think about these harder than the models. And one of the things I just want to point out is the impulse responses that he showed are really different equilibrium outcomes depending upon the structure of the model that you've written down. So what we're really saying is once you start to think about financial frictions in your models and you put them in, for any given shock, you're going to see a different behaviour of this economy because everyone else is optimising around that structure that you've put in place. And that's the agenda that we're trying to pursue when we think about these things. So we're putting richer things in banks, we're putting richer things in other areas, which I'll talk about very briefly. But the idea is to provide a richer characterisation of the economy than a very simple output gap type model, where all that mattered for thinking about the economy was a forecast of capacity. And if you think that's laughable, if we were having this lecture 10 or 12 years ago, that's all we would have talked about in terms of monetary policy, was the current and expected output gap. Whatever that is, actually. There are certain people who will shout at me. The former chair of the Philadelphia Fed would sort of put his arms around my neck if I ever said there's an output gap. Plosser. Who knows what the idea didn't exist in his world. So I think it's wonderful to hear Michael not only have come from the IMF and start working at the Bank of England, but really turn these ideas that have always been going around in central banking circles, for those who understood money, into models that we can use and understand the perturbations of the economy within. It was interesting, given all our problems with the IT, that at the very time that Michael stood up, his colleague John Cunliffe was giving a talk called A Series of Unfortunate Events right now in the city. So the bank knows everything, it seems to me. What I'm going to talk about is a little bit more general, because I guess Michael will talk about his paper, and I don't think there's a great appetite for me to go through another DSG model. Most of the time, never, but particularly today, I guess. This two-finger thing is not working for me. Okay.
Oh, you have to be careful.
Yeah. Not careful.
Would like you to.
Show me I can't even use a PlayStation remote control. Don't expect it to go like that. So, this is an argument I was thinking about. I was invited by the Banque de France to come and talk about kind of the policy instruments that have been used after the financial crisis and the extent to which they were completely disconnected from the models we were using to understand the macroeconomy prior to the financial crisis. Normally I wouldn't have gone, but it was in Nice in the summer, so I thought I would put my profession first and sacrifice myself and spend a couple of weeks in Nice talking to the Banque de France. I'm sure you wouldn't have had time to do that, but I managed to get across to do that. But there were a number of things that we had to do as policymakers that were not in the model, were completely outside the remit of what we thought we had to do. Remember I said all that really mattered was the output gap. Well, in that world, you've just got to make demand equal supply. And in that world, therefore, you've just got to jiggle around the interest rate to the extent to which demand does equal supply, because we think the interest rate, policy rate, bank rate impacts on demand in a particular way that we understand. So provided you can jiggle around interest rates enough, you can always make demand equal to supply, you can always stabilise the inflation rate. But let's look at the list of things that we suddenly had to do from 07, 08 onwards. And each of them are actually related to financial frictions or the way that finance changes that basic model of just trying to understand output and supply. And I think Michael gives an excellent position of the role of banks, which we can talk about. But there's a bunch of other stuff. And what it all means, if you can't see the bottom of the slide, is that it's very hard for us to completely characterise the economy in the realm of finance, and that'll be my final point, because we haven't got a workhorse model. Finance infects every bit of the macroeconomic agenda, and until we've worked it all out, we're not going to have a model that we can exposit as the model of the economy. And maybe we'll never get there. I probably won't get there in my lifetime, I'd imagine. Because once we start thinking about it, it affects everything that we do. So the policymakers who adopted these, let me just go through them quickly, I think did a remarkable job. I know that's not a fashionable thing to say. What we tend to stand up and say is how awful are our policymakers, how terrible was our Chancellor of the Exchequer, we hate these guys. Actually, if you look at the size of the shock and the fragility of the banking system, where we are now is an outcome I, as a risk-averse individual, would have accepted ex ante given the size of the shock. It's maybe a complicated statement, but I think what that means in the end is that actually we didn't do too badly. And the way we did it was guessing what the responses were. So let me just go through them. We thought monetary policy was not going to be constrained at the zero lower bound. We did a lot of work about 10 years ago. Japan had hit zero interest rates. And the idea was to try and understand through stochastic simulations how often the economy was going to be hit by a large enough shock so that interest rates would have to go lower than zero, at least theoretically, if not in actuality. And the research tended to suggest about 2% of the time. So 2 in every 100 years. The research was done in about 2003, and since that time, about 50% of the time, we've had to be constrained by the lower zero bound. So at that point, if bank rate cannot operate in the way I just described to try and stabilise demand, you're going to have to think about other ways of alleviating market interest rates if you want demand to catch up with supply. And all of those things require a knowledge of finance, which I'll go through shortly. Now, fiscal policy, we understand, we're in Cambridge, we understand aggregate demand management, or certainly the faculty I know do, bits of it maybe not don't as well. But we understand aggregate demand management, but there were a bunch of other constraints on fiscal policy that we hadn't appreciated. And let me point to two. What if the only credible paper in the market is the government? Corporates are so much in trouble, and banks are so much in trouble, that bank capital could be eroded. What if the only thing that can recapitalise a bank because they're undercapitalised is a government bonds or government guarantees themselves? In that world, there's an extra constraint on the limit to fiscal policy. You can't go to 100, 150% of GDP or 170% of GDP if it means government debt is treated as risky, because at that point you can no longer recapitalise banks if you're seen to be just as risky as the banks themselves. You have an extra constraint on the limit of fiscal policy. And you have further constraints. Because you're at the lower zero bound. If you get another large shock, and you've already used all your monetary instruments, you might have to use fiscal policy again. So the option value of fiscal policy had to be thought about. And then you need to have even tighter monetary policy than you might have ideally wanted given aggregate conditions, because you might want to hold another bit of ammunition back. Now, some people will tell you we price government debt according to the risk of government. But at that point, once we understand the level of risk, the demand for debt is perfectly elastic. Nothing else matters. Actually, it turned out that very large quantities of debt, the demand curve becomes, rather than perfectly elastic, starts to become rather inelastic, which means that in order to hold it, we need to have the price fall, which means the implied interest rate rises. If the implied interest rate rises for government debt, it's going to drive up other market interest rates. At the moment, when aggregate demand is low and requires lower interest rates. To understand these impacts, we need financial demand and supply curves in our models as well. We can't deal with perfectly elastic demand curves. We need to understand the demand for government debt. Not in any model, or aggregate macro model, since Tobin 1981. We'd forgotten it. A generation of economists had forgotten this idea. Now, the banks that Michael's been talking about are maturity, transformers in some sense. They're of course creating loans that are generally of longer maturity, and the deposits that back those, that result in the loans themselves, tend to be of lower maturity, and this leaves them open to all kinds of liquidity issues that may require them to change their behaviour or to be controlled by macroprudential instruments, and I'll kind of give you an idea of what they're trying to do theoretically as well. The balance sheet operations adopted by central banks are really a reintroduction of open market operations on a persistent basis, and the purpose of those open market operations are twofold. To affect market prices and assets when you can't use bank rate to affect them anymore, and in principle to allow the private sector to hold its increased demand for liquidity, in the sense in which following the financial crisis the demand for liquidity may be more than the private sector is able to supply on its own. So the central bank, as the provider of ultimate liquidity outside money, can provide that liquidity to the private sector. And that can alleviate what would otherwise be extensive and persistent liquidity premium. So one of the things we discovered, we're going to issue short-term debt fiscal instruments. These are reserves that pay interest. And these monetary fiscal operations that I've just outlined are hedging liquidity. Now, these are the instruments we ended up with, but mostly we ended up with them without having embedded the various issues I've talked about in a good macroeconomic model. We kind of guessed that we had to do these things. We bolted on little bits of work, often late at night, in central banks around the world trying to work out what to do. And the process of the macroeconomists who sit in universities is to think, actually, we put these in my models, and then I can understand systematically what kind of things I should be doing that we weren't doing before. And they lead to quite different results. Now, is it forward or back? This. So, Michael's predecessors, and I left the bank after this report, so I helped do something. So when they were thinking about transmission of monetary policy a generation ago, when you were all 5 or something ridiculous like that, the way monetary policy is working is there's an official rate or bank rate that's moving, and that's affecting the constellation of market interest rates. It affects asset prices for standard reasons, because if you change the interest rate, you change the discount rate at which you discount the cash flow from the returns on assets, so asset prices move in two directions. It's not explicit here, but asset prices may be collateral for the kind of bank lending that Michael was talking about, so it may be an amplification mechanism. If asset prices rise, you've then got more collateral opposed to a bank that then can lend to you more, so you might get different equilibrium as a result of that. Official rates, changing official rate might affect confidence. You've lost your job, your family's left you because you're deadbeat, but at least the Bank of England can reduce interest rates by 25 basis points, and therefore you're going to feel happier than you would otherwise. So you're going to think all is not lost. That's the way policy affects the expectations of confidence. And of course it might affect the exchange rate. The exchange rate in the UK is very stabilising in the sense in which after ERM exit it fell by 15%, and that helped the economy in recovery. After the economic crisis, the exchange rate fell by 25%. That certainly helped the economic situation. It would be much better than otherwise. And even on Monday, when the exchange rate fell by 2%, that was helping exporters, helping us arguably hit our inflation target. At the same time, some households may be worried about uncertainty. So exchange rate movements are helping offset shocks that are coming along. So I think of it, you can see my views on exchange rates and open economy flex exchange rate type of guy, which is, I guess, the standard bank position anyway. These things are affecting domestic demand, and net external demand together, they lead to total demand, and the gap between total demand and capacity gives you inflationary pressure, and by moving interest rates in some magical way, you can stabilise inflation. Nothing in this report to the Treasury Committee mentions banks. I don't think the word money was mentioned. Asset prices are kind of there, but not in an explicit manner. So we had this view that it was the real economy stupid, in some sense. That's what we had to look at. Unit labour costs, output gaps, inflation expectations were really all we had to kind of stabilise if we were worried about the economy, not what the financial sector was doing. Was it up or down? I've gone too far. I always go too far. There we go, I missed one in the middle. Now, the other thing to think about finance was very well put by Andrew Crockett, who was in fact my first boss at the Bank of England. And says that the received wisdom is that risk increases in recessions and falls in booms. But when you start to think about finance properly, and I think this links to some of the things Michael was saying, it's more helpful to think of risk as increasing during upswings. Because banks are lending more, people are taking on more debt because we're overconfident. And probably interest rates are too low, there's no sign of inflation. We're kind of thinking everything's changed. We'll see time and time again. I've lived long enough to see that happen 3 times. You guys have seen it once. You'll see it again. There'll be a boom and everyone will say everything is different. It never is. And so the risk actually increases during upswings as financial imbalances build up and materialise in recessions. So recession is just a materialisation of risk that has built up in the system. That's exactly the right way to think about it. So another way to think about finance are the kind of policies we need to adopt, not to stabilise the economy in a cyclical manner about inflation, but to build better buffers, to deal with tail risks. And that's what macroprudential policy is about, getting banks to hold more capital, more liquidity, screen their lending in a way that doesn't lead to the volatility that I think Michael was kind of pointing to. Think carefully about what you do. I won't talk about watery this before all of you this time. No, it's actually now getting to be fun now that I've spoken too soon. No, don't do that.
Just go back on put the mouse on the slide.
I've got a constraint, we're 21% battery, so I noticed an overall budget constraint. Thank you very much. Okay, so let's go 101, Economics 101. In fact, I may have shown this slide to the third years this year, so Economics 101 cuts across many years. But so the simple monetary policy simply says, look, inflation is all that matters. We have an interest rate that there's a natural rate in the set out there that's clearing supply and investment at some level, clearing the market. It's a unique level. It may not be unique. Let me take that on the chin, but I suppose there's some unique level natural rate. The Fisher effect says that the nominal interest rate will increase 1-for-1 equiproportionally with inflation. So we end up with an inflation target that reflects this dotted line, and the long run interest rate is going to be the addition of the natural rate and inflation, and that's kind of it. There's no reason that inflation should be could be any number you want. The long run interest rate could be anything that you want. But having got this view about a market clearing real rate, the nominal interest rate just reflects the long run inflation target. So all we need to bolt on top of that is a policy function, and the policy function says, look, and that's the green line, if inflation is above target, I increase interest rates along the policy function by more than the Fisher equation, so that real rates rise. These real rates bear down on aggregate demand, so that inflationary pressures go back to target. Similarly, on the other side, if there's negative inflation pressure below target, the policy function says I reduce interest rates by more than that. That reduces real interest rates, pushes up aggregate demand through consumption and investment, and pushes us back to equilibrium. So all we needed to do to stabilise our economy is forecast inflation, something that's off model here, we just make inflation a function of the output gap. I can then go home. The MPC meeting is very simple. I can have port and nuts at 12 o'clock. I go home. And this is really all they did. But that's an unfair characterization. And so the long rate is 5% because small perturbations are kind of fine. Now, two things to point out. Finance is in a sense potentially affecting the natural rate. So the natural rate is not deterministic, fixed over time. There could be a world in which the actual natural rate that's required to stabilise your economy is different to that which you think it was. In that world, you might be imparting shocks because you've got the wrong implied interest rate. It's very hard to know what the natural rate is. There's a large degree of uncertainty about it. I was at the Treasury Committee yesterday. A number of MPC members were asked what they thought the natural rate was, and none of them said 2.73. Kind of mostly somewhere between 1 and 4%, which is tremendously helpful if you don't know. It means that you can get it wrong. In a world in which you can get it wrong, it means that you can have the wrong, in principle, real interest rate if you think there's a particular one that's going to clear the market. The other thing you can see immediately is that for a large enough negative shock, you're going to lose the ability to stabilise this economy. You're going to hit zero. As inflation continues to fall, the real interest rate is going to rise. If the real interest rate starts to rise when demand is low, you're bearing down even more on demand, creating more of an output gap and driving inflation even lower. So in fact, you end up going towards another equilibrium, B. And some would argue that's the one we've ended up in the world in which we're unable to get rates below zero, inflationary expectations or the confidence in the economy, however you want to write it down, is poor, and we're in some world where B is ended up as the equilibrium, with inflation around zero or slightly negative, and interest rates suck at zero. That could be one argument. I don't want to kind of get into that, because another argument is that, well, okay, if I can't use the policy rate, what I then have to do is think about other market interest rates and how I influence them. And that's where I get into balance sheet policies and thinking about fiscal policies so that long-term interest rates are low. And what I'm doing in effect there, I'll try to say this as briefly as possible, I can't affect the short-term policy rate, but I can affect long-term policy so that the short rate that was implied by very low long-term rates implies some kind of implicit negative interest rate here. So you can have an extension of this line down here that would be a sort of shadow interest rate reflecting the balance sheet policies that have got low interest rates down. But to work all of that out requires finance in your models. It's not something you can just suddenly decide what to do. That didn't work very well. In the same boat that I was a minute ago. I'm allowed not to know how to use a Mac. I'm old. You should know much Okay, thank you. It's 10 to 7. I'm going to try and finish in about 5-6 minutes because it must be nearly time for a drink. Yeah. In fact, may I recommend for future occasions you have a drink? Yeah. I mean, far be it from me to influence the way you run things. But, in the financial crisis, you're adding to public debt. That's what the blue line is. You're adding to public debt as a result of. But if you ask people to hold too much debt, they want to buy it at a lower price. That implies a higher interest rate. So the way you might want to affect that interest rate is to take that debt out of the market and buy it through a Bank of England operation called Quantitative Easing. And you can see the kind of quantities of the red line above, kind of taking that stock of bonds out of the market so the private sector doesn't have to hold it, so you don't get that price and interest rate effect that I was talking about earlier on. There's not much time to talk about, but there are bunches of papers that people, myself, have written. This is with colleagues at the BIS, but Fabrizio Zampoli used to work at the Bank of England, so we're all a big cabal together looking at this stuff. Macro predictions, I already talked about en passant, and what I want to do is think about what they mean. So let me give you a Brainard chart, which is always fun. So I want to stabilise inflation, which is that target in the middle of the list point there. And let's suppose I understand the financial sector is something that I don't understand very well. So it's a kind of Rumsfeld type story. It's a known unknown, rather than unknown, a known unknown. So if I have a current inflation rate of A, and my inflation target is set on this axis here, if I want to hit the target, I want to get to that blue line there. But in order to get there, I have to use instruments that I don't understand, which might be macroprudential instruments, or that I'm using policy only that's about bank rate, and I'm deciding not to look at the financial sector because I don't understand it, or somebody has told me the financial sector is always going to look after its budget constraint, it's never going to go bust. It's full of very sensible, well-behaved, disciplined people who never cheat and lie. So I'm going to leave it alone. Okay. Now, so what happens is, because I'm not fully controlling the economy, if I try to use my instruments to get back to my target, which is the centre of that bliss point up there, I'm injecting some uncertainty in outcomes in the economy. Because I've got instruments that are noisy, they're not perfect instruments. It means that if I try to get interest rate inflation from A back up to that point there, I've injected more economic variance or risk into the system. So as a result of that, once I start to think about the risk I might inject into the system, you can see my preferred point here will not be C, where inflation is a target. It will be at B, where I'm nearest to the bliss point. And in effect, what I'm doing there is trading off a mean outcome for a small amount of variance. I would rather be at B than I would at C. Because at C, okay, I hit my mean outcome, but I've got even more expected variance in the system. Because I've got a bunch of instruments that don't perfectly stabilise the economy. So I'd rather be at B. And once we start thinking about things in these terms, macroprudential instruments become clear to us. Because what they're doing is making this ABC line steeper. If we can make it steeper, we can get to a point at which, I didn't have time to load the second chart, but if you imagine this is steeper, you get a point to which you'd actually be much closer to the inflation target. There's no point to it, you've got to sort of do it in your head. If this was a very steep line, or in the limit, if this became vertical, because your macroprudential instruments got rid of risk, that's the best way to see it. Let's just go to the limit of the economist's argument. So we go from that line, let's go to the limit, where our instruments are so good that by using them we don't inject any risk into our economy, we can get back to our target, which is our dot there. Or at the very least, we don't have to give up on B. Every time this gets steeper, it's a more efficient set of instruments. And that's the way you should be thinking about the way macroprudential instruments are working on other elements of the economy where there's risk. Another way finance kind of matters. Let's suppose, in fact there's a triumvirate out there, monetary policy, fiscal policy, financial policy. Let's just think now about NPR as a monetary policy reaction function, and FS as a financial stability reaction function. You may know there are two bits of the bank, the financial and the monetary, and of course they all talk to each other, they're all friends, there's no arguments between them, they're all out to dinner regularly, aren't they? All agree with each other. So imagine a world in which the monetary policy maker, this is a kind of Nash diagram for those of you who have already done this stuff. Imagine a monetary policy maker says, look, as activity is higher, my reaction function is that I'm going to want higher interest rates. Because I worry about high activity. I don't want lots of parties. I want people to be under the cosh of high interest rates if there's too much activity. And let's suppose the financial sector has a similar kind of reaction function. They're both going for the same target. So social preferences are that the financial sector and the monetary policy sector have got the same bliss point and the same set of concentric indifference curves around it. If the financial sector is stabilising, in the sense in which, let's suppose we end up with a low level of activity, we lower interest rates. When we lower interest rates and we want more demand in the economy, let's suppose those lower interest rates lead to higher asset prices, more collateral being posted by people who want to borrow, more lending, therefore more activity through consumption and investment. We then drive up to that line there, on the red line. That higher level of activity could mean that interest rates could start to rise again because the economy is doing better, but interest rates are still below their long-run equilibrium, so the financial sector is acting as an impulse for stability. It's driving this economy back to stability. So I sometimes like to characterise this as a nice Scandinavian sort of financial sector, one that's working and helping the real economy get back to equilibrium. now that nasty Anglo-Saxon financial sector, of course, what we find here is that if we're in a bad state of the world where activity is low and interest rates go low, in that world the financial sector stops lending. The financial sector says the world is too risky, I'm not going to lend to people because they're not going to pay me back, I'm going to increase risk premium, I'm going to hold back on lending, and by doing that I'm going to amplify the economic cycle in a very bad way. And I'm going to drive the economy away to some sump that we're going to sit there for a very long time. Think of Japan. The financial sector is not responding. So the policies that are in place are an idea here about trying to get a world in which the financial sector slope is such that it stabilises what the monetary policy guys are trying to do with the economy. There's a whole bunch of ways you can play with this. You can have different social preferences, and we know that they're unstable because the way they work requires strong coordination, institutional reform, so that we lie on that contract curve. But everyone has the sort of incentive to go to the national equilibrium, so we're going to end up potentially with higher interest rates and higher activity unless we have very strong institutional reform. Another world is that the monetary policy maker is continually trying to set interest rates on their contract curve, but the financial sector gets increasingly frothy. And this is a way of characterising what was going on in the North. The financial sector is injected with liquidity from the sovereign wealth funds in the emerging parts of the world. They're intermediating assets. The countries that Michael was talking about that were having very high levels of domestic lending with relatively low levels of saving are of course borrowing from abroad. Their net foreign asset position is going negative. Both the UK and the US have very strong negative net investment positions because they've been borrowing from abroad, so the savings we've been tapping are from the rest of the world. The financial sector could get very frothy, and the only way you can solve that in a nash world is to have higher and higher interest rates that ultimately bear down on activity. I'm not going to talk about forward guidance. I'm going to go to my final two, if I can. So just trying to wrap up, that's all. It will work. Thank you. So, finance, once we think about it, implies that we have a constellation of interest rates, not just one market interest rate. There's the interest rates of the external finance premium that require collateral, interest rates through bond markets, interest rates from overseas borrowing. Lots of interest rates to think about, which collectively help stabilise the economy. So we need to think of a vector of interest rates, not one. That's the first thing that finance tells us. Asset prices back credit and debt creation. They might be stabilising or they might be destabilising. We can't necessarily be sure. Part of what selects whether they're stabilising or destabilising is in fact the policy rule and the policy regime that's in place. And that's what we can see when we play with DSG models. One thing I haven't had time to touch upon, financial frictions make standard output gapology very hard because financial frictions affect both supply and demand. So think of a world in which financial frictions are low, it's going to look like there's a lot of capacity in the economy and there won't be any inflationary pressure. In fact, exactly at that time, you should be tightening policy to try and offset some of the excessive frothiness. So it makes it very hard, particularly if you're an output gapologist. Financial friction. Fiscal policy needs to be rethought. We need to think as well about the external position, the way that makes borrowing more expensive, maybe ultimately making the exchange rate more fragile in the UK than it has been in the past, and we've seen some evidence of that. We need to think about those things as well, particularly if we're going to be net borrowers. In the past it didn't matter because the rate of return that we got from our foreign assets was very high compared to the interest rate we had to pay on our debt. That's all converged. So we're having current account issues as well as that. And we need those in our models, the ultimate balance sheet. We need to work out a sensible quantity of liquidity and capital in the banking system. All of it means is that understanding policy is considerably harder than it was pre-crisis. Inflation targeting loan, as it was practiced, clearly cannot prevent boom and bust. I hope that's not too controversial. We need to understand better money and its counterparties in the way that we've heard. Financial freedom we've already talked about. And ultimately there's a monetary, fiscal and financial nexus. It's not just monetary policy. We need to think of all of these things. And that point I've already made. Thank you very much for listening.
questions? Anybody has any? Yeah.
Thanks. I thought both very interesting talks. So what I take away from from your stories together is sort of that for different reasons the actual transmission mechanisms of monetary policy is much less well understood than we thought, and possibly also much less easy to understand well, because there is much more discretion from the sides of banks involved, and that it's therefore very difficult at this point, at least, to say what the effects of particularly interest rate changes are going to be. So in those circumstances, is it still really responsible to put so much emphasis, particularly on interest rate targeting in monetary policy and
I want to save Michael from having to say anything that is problematic. Talking about interest rates is very high.
Okay.
I think so. What we've seen is a very clear response from policymakers to that very idea, and so what they've been is very, very careful in trying to provide as much forward guidance about when interest rates will go up, and try to explain the conditions under which they'll go up, because they understand that the system may be very fragile. And there's a point I make to my own students is that when interest rates are zero, bond prices are at their highest by definition, and if you look at the convexity, they're the most sensitive. So you might see very sharp financial responses to interest rate moves. So you kind of want a world in which you signal as much as you can in advance that they're going to change. You need to revise your forecasts in the light of news, and that's why you've had continual delay in interest rates. But I think what you're seeing is use of the continual phrase gradual and limited. So gradual means that whenever they start to move, they're going to move very, very carefully, because they want to judge the response of markets to that. But also that they're limited. So that's the way of saying they're not going to go back to 5%. They're going to go back to something considerably less. So you can plan your finances if you have a mortgage. You guys won't need mortgages. You'll get a bonus in your first year at Goldman Sachs, and you're not going to need to borrow again. You won't be constrained. But most of us have got mortgages. And if we know that, in principle, over the term, it's not going to go over 4 or 5%, we can budget accordingly. We're not going to be hit by a very large shock. So I think that's the way that they've responded rather than anywhere else. They understand that they don't know, so they've gone to the world of doing things very gradually in a limited manner. Is that satisfactory? You're looking unhappy with that?
No. So I'm just wondering what that means for the future, right? Does that mean that with information available now, we should remain so restrained?
Well, I think one way to think about it is that when we get back to completely normal times, interest rates may go back to normal. We're continually living through extraordinary times. And even though, conditional on the size of the shock, where we are today is acceptable, there are clearly still considerable fragilities in the system. Household debt to income is still 130%, it's large. Public debt is the best part of 100% if you take out financial transactions. These are incredibly unusual times, looking much more like the position, certainly on public debt, that we were in the 1950s, 5-6 years after World War II. And interest rates then, of course, were pegged at 2% for a considerable time as well, which is higher than 0.5%, but still they were kind of pegged in order to help us get those levels of debt down. So all these things mean that it's going to take a long time before we get back to normal, I think. And the response from policymakers is therefore to move very, very gradually, not to disrupt what is a reasonable recovery, but I wouldn't say so robust that it could be derailed by a bad policy choice. And we've seen the reaction in the markets in January to the federal funds increase in December, which was extraordinary. In my world, a fall in oil prices is a very good thing if you're an oil consumer. To sort of treat that as a piece of bad news just tells you how nutty markets are at the moment. I don't want you to have to say that. Thank you. Yeah.
Thank you. I apologise again for the technical issues, but I hope that didn't overshadow the fantastic talks we've had. And I'd like to thank the speakers for joining us again.